Let's go over some supply and demand basics of how markets work, right? If you look up supply and demand trading on YouTube and stuff like that, you're going to find various videos, but I want you to just focus on this video for 1 second. This is very, very basic supply and demand, and we will be able to incorporate this in our trading if we learn this, right? So let's say we're Walmart or we're Kroger or we're a grocery store, or we are more or less the market maker, right? The market maker has goods at a certain supply, right? And they want to price that determining on how much supply they have, right? So let's say we have X amount of bread, right? We're basically looking to see if we want to raise or lower our prices based on, let's say we have the same amount of supply, okay? The supply is about the same. We want to know if we need to raise or lower our prices, okay? The only way that we are able to know that is the amount of interest. We can see the amount of interest at this price, okay? We'll take this as the volume slash the interest, right? And we'll say this is going to be our price. Okay, so here we go. What we're going to do is, let's say as we're lowering the price, as we are lowering the price, all of a sudden we have more interest. So what does that mean? Well, it means that buyers or people are saying that, wow, that was a good price there. It's lower. That means that it must be cheaper, because this is a psychological, right? It means it must be cheaper, right? So what happens is, if people are saying that it's cheaper, market makers are going to mark the price back up, right? Because the market was saying it was cheaper. Now, what the market makers want to see in order to raise the prices even more, right, is as we mark prices back up, is there more interest? What that means is that people not only said that that price below was cheaper, but they don't think it's going back to those prices, right? That's essentially what it means, is they don't think it's going back to those prices, so they're buying more the higher it goes. Makes sense? They're buying more the higher it goes. It's a FOMO. It's a let's get in now. I want to see it increase in price. It's not going back to the previous prices, right? So that's one scenario that of how market makers can price things, right? And let's look at it another way. Like, let's say we start off at a price, we don't know what to sell our goods at, and we move the price down. We have a specific level of interest. We're moving the price down, okay? And as we continue to move it lower, what we're seeing is there's less interest. There's less interest as we move it lower. Buyers are saying this is expensive, right? They're saying this is essentially expensive, right? That's essentially what they're saying. As we move the prices lower, there is a less amount of interest in it as we move the prices lower. So market makers can test the market and see if this is real, or they're basically faking out, right? They're saying, no, I bet it's going to go lower. I bet it's going to go lower. Because a lot of times people are so psychological that if the market even goes up a little bit, they don't really think it's going to go lower. They're just waiting for it to go up, right? So the market maker can raise the price a little bit. And when they raise the price, they see a spike of interest. Okay, oh, there's a spike of interest now. They raise the price, right? Raise the price more. There's a spike of interest now, so buyers are now saying, "Wow, that's I mean, look at that. We were at a low price here, and it's now came up this much. Wow!" I tell you what, let's see if it goes back down to that price. If it goes back down to that price, I'm gonna buy it because that price seems cheap. That price seems low. So essentially, that's what happens, right? Essentially, as we mark the prices down, you will then see more interest as you mark the prices down, because that is basically saying that this is now becoming cheaper. This is how support and resistance is created, guys. Okay? It's all psychological. It all has to do with, oh wow, that was a cheap price there. Look, we ran up from that price. I tell you what, if it goes back to that price, I want to start buying there. So that's how we can identify support and resistance, and if it's going to hold. If the support and resistance is going to hold, we're going to be able to see it in the inventory or in the interest, right? I think this is a very important concept to understand, right? Because we can now see why prices are at a certain price and how to identify markdowns or markups. Because, guys, understand, if price starts here and there's very low interest, I mean, interest is so low and we have so much supply. Guys, we have so much supply up here. Look at that. Look at those markdowns. That's what we call a markdown in price. And essentially all, you know, this is, they mark down, mark up, mark down. That's what the market maker, their job is to mark down or mark up prices depending on interest, depending on supply, depending on demand, right? So if we see markdowns like this, markdowns in price, and finally we're getting interest, yes, that verifies that that market was too expensive, right? So essentially it will still determine on how much supply the market maker has to how much lower they're going to take it, right? Because if there's a fair amount of interest at these levels, if there's a fair amount of interest here, they might be able to get a good price or a better price for their product, right? So if they say at these prices there's a good amount of interest, let's raise it up. And if there's not enough interest to match their supply, right, they're going to mark it back down to where they might have more interest here at these prices again, because there was less interest here and we have more interest now here. So this is essentially how we can predict exactly what's going to happen in the market. We are able to separate the market makers from the participants. You have to be able to make this distinction, right? If you're able to make this distinction, say, okay, the market makers are marking down prices, and as they are marking down prices, we're seeing an increasing level of interest. That tells me that as they mark prices back up, after they see that level of interest, and we come back down and we're seeing the same kind of interest, those levels, there's a high probability it's going to hold that level. That's a trade I want to take as a trader, right? So this is essentially how we can use supply and demand, guys, okay? Understand this, that the market makers and the participants are two separate entities, right? And the market makers, essentially, they want to capitalize on how much supply there is in relation to the demand, right? So that's why we need to be able to see charting history and stuff like that. And we don't really need to see that if we can really understand what's going on right now, but it helps. We want to see previous demand. How much demand was here when market makers marked down prices? Because at those markdowns, if we have a sharp markdown like this, right? If we have a sharp markdown like this, essentially that means that there is more supply than demand that they would like, and they're going to continue marking prices down unless we have increasing interest, right? So if there's less interest as they mark prices down, it's going to continue until interest comes back in. So very basic, right? This is extremely basic. It's not rocket science, and I mean, we experience it when we post on, the marketplace, Facebook Marketplace. Oh, nobody's buying it. I got my silly rug, or I got a refrigerator priced at $100. Nobody's buying it, man. But then I priced it at $80. Everybody wants to buy it at $80? I mean, geez, it must be too cheap. So you raise it to $90. And you get less people willing to buy it at $90, but there's still a fair amount. So fair value is a real thing, right? As we can see in this second frame, right? In this second frame, fair value is a real thing. As we came back down, and fair value was about here, right? This was about fair value, this black line. So we can see that the market always wants to find its fair value and be able to retrace and get the best bang for its buck. The market is always balancing itself out like that. So yeah, once again, very, very basic, and this is something you can implement into any time frame when you trade, right? Is there more supply than demand here? Well, let's see. Market makers marked prices down, and clearly they marked prices down because they had more supply than demand. Otherwise, they wouldn't have marked prices down, right? If there's more demand than they have supply, they're going to wait until there's less interest at a price, right, that they're willing to get for it. Then they'll mark prices back down. So take this into consideration of how to correctly use supply and demand. And that's why you see volume bars being used a lot. Volume is a way to identify the interest in that price, right? So 100% believe that this is very, very useful, right? And I hope you learned something from this video. If you did, like, subscribe, all that stuff. Essentially, even join the Discord. I have a Discord in the description there. It's just a community of traders. We're not really, we don't make crazy plays or, do all that kind of. We're just a community of traders, and we talk about stuff like this. So, yeah, I hope you enjoyed. Have a nice day.